TDS. So firstly, we should know the meaning of TDS. TDS stands for tax deducted at source. Any income payable to the assessee shall be liable for deduction of tax at source by the person responsible for making payment. TDS is deducted at prescribed rate as per the Finance Act of that year. Assessee pays tax in the assessment year on income earned in previous year. Due to this rule, the tax collection is delayed till the completion of the previous year. Even sometimes, people conceal their income and the tax is not paid at all. In order to overcome these problems, government started to deduct some amount of tax from the amount which is receivable by the assessee. The amount of tax so deducted is called as tax deducted at source or TDS in India. Sum of such income that is subjected to tax deduction at source is as follows: salary, interest, rental fee, interest on securities, insurance commission, dividends from shares and UTI mutual funds, commission and brokerage, prize money won from lotteries, horse races, etc., payments to non-resident sportsmen or sports associations, commission on sale of lottery tickets, fees from professional and technical services and the like, compensation for compulsory acquisition, income from units of an offshore fund, income from foreign currency bonds or shares of Indian companies, unless specified as tax-free. For the purpose of TDS, the employer or DDO may allow some of these deductions to the employee on furnishing of the required particulars. The deductions allowable by the DDO or employer are being described. Payment of premium for annuity. The premium plan of LIC or any other insurer be deposited to keep deductions available up to a maximum of Rs 10,000. For payment of medical insurance premium, deduction is available up to Rs 10,000. Deduction of Rs 40,000 in respect of expenditure incurred on medical treatment including nursing, training and rehabilitation of handicapped dependent relative. Deduction in respect of repayment of loan taken up to Rs 40,000 per year. Deduction of Rs 40,000 to an individual who suffers from a physical disability including blindness or mental retardation. After studying this lesson, you should be able to TDS basic concept, TDS rates on different transactions, obligation of deductor, implication of TDS provisions not followed. Now let's discuss TDS rates on different transactions. It can be understood under following heads: Form 26Q, Form 27Q, Form 27EQ. These all have their own tax rate with regards to different nature of payment. We can study them in detail in further discussion. Let's discuss Form 26Q. We can see the table in the slide and understand how Section 193 to 194 have different modes of incomes and how tax is deducted at varying rate. Like in income for interest on dividend, we pay TDS at the rate of 10%. The rate, if TDS is 10% for the insurance commission more than 5,000 rupees, where the professional technical fee increases to more than 20,000 rupees. There will also be 10%. While repurchasing units of mutual fund and UTI, it will be 20% and so on. Now let's discuss Form 27Q. It constitutes different nature of income in varying section from 194E to 196D. The payment to non-resident sportsmen or sports association have TDS rate of 10%. Income from foreign exchange assets payable to an Indian citizen have TDS rate of 20%. Income by way of short-term capital gains, US 111A, has tax rate of 15%. Any other income have tax rate varying from 30% to 40% and so on. Now let's look at Form 27EQ. It includes collection code from 6CA to 6CI. The tax rates are alcoholic liquor for human consumption, 1%. Timber obtained under a forest lease, 2.5%. Timber obtained under any mode other than forest lease, 2.5%. Any other forest product not being timber or tend to leave, 2.5%. Scrap, 1%. Parking lot, 2%, and so on. Now let's discuss obligation of deductor. The tax deductor is the agent of the revenue. All drawing and disbursing officers of central and state governments come under the category of government deductor. If there is any violation on the part of a tax deductor, the consequence should fall only on the revenue and that cannot be foisted on the assessee. The Income Tax Department of India has made certain obligations for the deductor. These obligations are discussed as under. The deductor will have to file an application in Form 49B at the TIN Facilitation Center along with application fee, ₹50 plus service tax as applicable for TAN. TAN once allotted can be used for all type of deductions. It can also be used in case tax is being collected at source also. The possible reasons for incorrect credits in Form 26A can be on account of wrong data provided by the deductor in the quarterly TDS or TCS statement. You may request the deductor to rectify the TDS or TCS statement using prescribed correction statement. PAN of the deductors has to be given by non-government deductors. It is essential to quote PAN of all deductees, failing which credit of tax deducted will not be given. The Form 26AS annual tax statement is divided into three parts, namely Part A, B, and C as under. Part A displays details of tax which has been deducted at source by each person who made a specified kind of payment to you. Every non-governmental entity that has deducted or collected tax at source is required to deposit the tax to the government account through a bank. Banks will upload this payment-related information to the TIN central system. These deductors are also required to file a quarterly statement to TIN giving the details of their TDS or TCS. The TIN central system will match the tax payment-related information in the statement with the tax receipt information from the banks. There are some implications of not following TDS, which are, if a person fails to deduct the whole or any part of TDS as required under any of the provisions of sections 192 to 196D, then the person responsible for deduction is treated as assessee in default. He shall be liable to pay by the way of penalty a sum equal to the amount which he failed to deduct. He shall be liable to pay simple interest at the rate of 12% per annum on amount of tax liable to be deducted. If a person, after deducting TDS, fails to deposit the same, then the person responsible for deduction is treated as assessee in default. A penalty sum equal to the amount which he failed to deposit. Section 271C. Simple interest at the rate of 12% per annum till the date of actual deposit in government treasury. Rigorous punishment for a term which shall not be less than 3 months and may extend to 7 years, and fine. Section 276B. Now let us check if we have understood the various concepts discussed in this lesson clearly. TDS stands for tax deducted for source. Right or wrong? Wrong. When government deduct some amount of tax from the amount which is receivable by the assessee, then it is called TDS. Right or wrong? Right. Commission and brokerage are subject to deduction at source. Right or wrong? Right. If a person after deducting TDS fails to deposit the same, then the person responsible for deduction is treated as payee in default. Right or wrong? Wrong. Now let's revise what we have studied till now. Any income payable to the assessee shall be liable for deduction of tax at source by the person responsible for making payment. TDS is deducted at prescribed rate as per the Finance Act of that year. There are different rates that apply for different transactions. The tax deductor is the agent of the revenue. All drawing and disbursing officers of central and state governments come under the category of government deductors. If there is any violation on the part of a tax deductor, the consequence should fall only on the revenue, and that cannot be foisted on the assessee. Filing of income tax returns is a legal obligation of every person whose total income for the previous year has exceeded the maximum amount that is not chargeable for income tax. If a person or anybody does not pay the tax due, a penalty of Rs 10,000 may be levied as per Section 272B of the Income Tax Act 1961.